From New York City for our audience worldwide, Bloomberg Real Yield starts right now. Coming up, investors gearing up for an economic boom, junk bond supply breaking a quarterly record, and Fed Chair Jay Powell sticking to script. We begin with the big issue. Show me the data.
The news just continues to get better.
An economic boom this year.
Growth has gotten upgraded.
A booming economy.
Retail sales in the U.S. has gotten a lot better.
The potential for another boom in the economic data.
Unfortunately, this is all starting to become old news.
Don't get just obsessed with the fact that growth is going up.
By the second quarter, we should have fully priced most of these surprises.
As we get more data relative to other opportunities, then we size it up over time.
The market tends to go into this overdrive.
The market is very much one-sided.
Extrapolating the rapid growth of the recovery stage.
8 to 12% nominal GDP growth.
The consensus forecast is getting jacked up.
Nobody I work with cares what my GDP forecast really is.
They want to see actual data.
We all want to see the actual data. Let's bring in the panel. Wells Fargo's George Bory, Morgan Stanley's Vishy, Tirupattur, and Megan Greene of the Harvard Kennedy School. And Megan, I want to start with you. We've all predicted the data. Most people agree on what it's going to look like through March, through April, maybe into May as well. How we respond to that inflation data as it creeps higher is going to be fascinating for me. What are you going to be looking for, Megan?
Yeah, so I think inflation is a process, and the Fed has already said that it expects an acceleration in inflation, but that it won't be sustained. And so I would be looking at expectations. So seeing whether inflation expectations are actually becoming unanchored, that's the important thing to look at. And you'll see that in market-based measures, but you'll also see it in things like wage negotiations. So wage growth could be an indication that actually people fundamentally believe that inflation is accelerating and is here to stay and are demanding more pay. And a wage spiral is the only way that you really get a significant sustained inflation spiral. So I would be looking at those two things.
What about you, Vishy?
I agree with that. I think we need to see substantial progress on the employment front. It's not just going to be the headline unemployment number. You need to see that number to be diverse unemployment. You need to see participation rate and the headline unemployment levels tending towards or growing towards the pre-pandemic levels. So I think that's the bar that the Fed has set for actual progress is not just the level of a headline number, but actually the composition of that unemployment rate has to be diverse and and high quality. And that's what I would be looking for. When you see those kinds of things, potentially, then you could start seeing pressures on the wage inflation.
The word I'll be listening for again and again, George, is transitory. We'll all be hearing that through the month of March, through the month of April, maybe into May too. I think we need to stress test the argument that it will be transitory and need to set things up right now over an appropriate time frame. I want to understand how and when I can tell if things are running too hot. How and when will I know that, George?
John, it's a great question, and I think Megan, sort of hit the nail on the head. It really comes down to sustainability, and particularly for inflation. Sort of the growth numbers. We're all expecting pretty punchy growth numbers, but they tend to move up and down in a relatively smooth fashion. We'll see a bit of a spike over the second quarter, but the more important numbers are really what happens with inflation. Some of the real-time indicators are showing actually a pretty material spike up in consumer prices. Now, if you look at break-even inflations, they've moved up, but the curve for break-even inflation is actually still inverted. So I think we have probably a good 3-month window where inflation can run sort of hot, if you will, both at a headline level as well as a core level. That would be kind of deep into the second quarter, well into the third. But if inflation keeps running hot or does not decelerate fast enough, that's when a lot of these assumptions will start to come under question. So the ability to surprise the market, in our opinion, really doesn't manifest itself until kind of middle of the summer, when we can gauge whether or not these numbers or sort of the underlying economy is actually starting to sort of moderate, or if we're going to continue this kind of acceleration.
George, I want to pick up on the number you used, 3 months. Megan, your view on that? 3 months. After 3 months, after the next 3 months, is that when the test begins for you?
Yeah, I would actually have a longer view period. So I would think it would take longer than 3 months. I think we need to, be looking over the next year, and the level is not as important as the path to get there. And so I think, how fast inflation accelerates certainly matters too. And I think we would need to see inflation, around 3% for a long period of time for the Fed to really think that they're behind the curve and need to actually address it. I would also say, though, that at the end of this year, the Fed itself expects unemployment of 4.5%. It's not impossible we could have inflation of 2.5%. And it will just be increasingly untenable for the Fed to argue that in those conditions, the appropriate policy rate is 0. So I do think that this debate around the Fed is going to heat up certainly as the year progresses. But I think our timeline needs to be a bit longer to know if we're really getting a sustained bout in inflation.
Megan, if they knew what they knew now, back in the summer, do you think they would have shifted the framework?
Yeah, absolutely. I mean, I think that the discussion went on for a year at least in terms of their monetary policy framework. And at the end of the day, what they did was pretty small. I mean, they just tweaked it and did a version of what they were already doing. So now they've got average inflation targeting, which fundamentally bakes in an overshoot if you've undershot for a while. But they had already said they would do that. So I would say that the tweak was pretty tiny and underwhelming, and they would have done it regardless of the conditions.
Do you share that view, Vishy?
Yes, I do. I do think that they would have done this regardless if they knew what they know now. I don't think they would have done anything much differently. Clearly, what they are looking for is subtle, tiny, but a very subtly important distinction. In the past, the response function from the Fed was guided and driven by expectations of future inflation. And now what they are saying is that strategy has not clearly gotten us to the consistently 2% type of core PCE inflation, and they want to see actual inflation. So this distinction from expectations to actual is an important, substantial difference, in my opinion. They would have stuck to that level, that construct, regardless, I think.
Vishy, I'm wondering how you think this plays out in the bond market on the Treasury curve through the next couple of quarters, and why the 7-year specifically, the belly of the curve more broadly, is having some trouble coming to market when we get supply. The 7-year last month, okay, it was in the context of a really, really volatile week for Treasuries, and maybe that wasn't a surprise. Yes, it exacerbated things, but think about the week that week. It was really choppy. This week, 7-year comes to market, largely expected to go okay. Vishy, then it doesn't. What do you think happened?
I think we have to keep in mind a number of technicals that are happening. There are clearly important technicals that we have highlighted, my colleague Matt Hornback and team have highlighted in their research, buying or the lack of buying or even selling from the Japanese investor base, Japanese bank investor base. And we can see that in the aggregate, the actual numbers in that context as well. Also, if you pay attention to when the big moves in the yield curve have actually happened, they've happened predominantly during the Japanese trading hours. Yep. Much of the US trading hours is not where we have seen the bigger action. So I think that these kinds of technicals have clearly played a big role. In addition to, of course, we were not thinking of, we didn't, if you step back a few months ago, we thought that the size of the incremental stimulus would be something in the 750 billion range. Indeed, turned out to be 1.9 trillion. Market was progressively assigning a greater probability of a bigger stimulus, and that stimulus did get realized at the high end of the range. At the highest end of the range is where the final stimulus is coming through. So those things have all factored into this decision, but don't forget the technicals.
A couple of factors to pick up on there, and I just want to finish on the foreign bid. George, I think we've all realised this, coming into work in the morning, switching on the Bloomberg and looking where the bond market is and wondering what happened in the Asian session with big moves in the Treasury market. The words of Vishy there on Japan, the demand abroad, does that resonate with you?
Well, it does. I mean, as we all know, sort of international demand for U.S. bonds, particularly treasuries, is very, very important. And, we did sort of see a bit of a wane, if you will, or a slowdown in demand. It's unclear how long that will last. And as you point out, the technicals are starting to look a little bit better. And I think the quarter end component and the year end for Japan in particular kind of rings pretty loudly to us. And as we get through the end of this month and we start a new calendar year for the Japanese investors and and the new quarter for the rest of the world, the same type of themes that have been ongoing are likely to reemerge. And as we've just discussed, there are sort of three big factors at play here. One is inflation expectations, the other is the term premium, and third is just the technical backdrop. When you combine all three of them, we've come a long way. The market is pricing in a fair bit as it relates to inflation expectations. The term premium still has a ways to go. It's back to positive, which is encouraging. And so you're getting paid to sort of extend out the curve. But as you just asked, Jonathan, sort of what do we need to see in terms of the shape of the curve to start to entice investors? Nominal yields are still relatively low. It's not a great value trade to sort of just rush out the curve, but the shape of the curves are starting to look interesting. And if you look at, say, the 5-year versus 10-year point on the curve, at at sort of roughly 80 basis points or so, a little bit more than that, that's starting to get kind of close to value territory. We're not quite there yet. We would say, that needs to move out another, sort of 20 basis points or so. But once it does, you're now at a point where sort of your kind of roll down, if you will, becomes very compelling. And so you are being paid to extend out along the curve. And I think a lot of investors are looking at that. We've repriced a long way, but we're not fully there yet. And that's kind of our main message to clients. There's a lot to do within fixed income, but you do have to tread pretty cautiously because of that sort of limited protection from just sort of low absolute yields.
George Bory, Megan Greene, Vishy Tirupattur sticking with us. Up next, the auction block, the junk bond bonanza rolling on, setting fresh records in the United States, a record quarter. That conversation up next. This is Bloomberg. I'm Jonathan Ferro. This is Bloomberg Real Yield. It's time now for the auction blog, where we kick things off over in Europe. And the continent's monumental debt deluge continues this year, topping 500 billion euros in annual debt sales in the fastest time on record. In the United States this week, 7-year Treasury auction seeing another abnormally large tail, even amid better demand, while direct bidder demand shined at the 2- and 5-year auctions. And in corporates, the junk bond bonanza raging on, high yield debt sales setting a new quarterly record, with companies racing to lock in low funding costs. Back with us, I'm pleased to say, is George Bory, Vishy Tirupattur and Megan Greene, still with us too. Megan, I want to come to you on financial conditions. Given we've just had a record quarter for high yield debt issuance in the United States, it's pretty hard to make the argument for the Fed that they need to do more to keep financial conditions loose.
Yeah, I don't think anyone's really trying to make that argument at the moment. And I know that some members of the Fed are worried about financial stability, which of course is part of their mandate, sort of secondarily, but still an important piece. And so I don't think it's likely that the Fed will do any more unless you get some major dysfunction in the markets, which hopefully we won't have coming. So I don't think there's any chance the Fed is going to do more, particularly when it comes to corporate debt. When it comes to treasuries, there is a chance, and some people believe that as the Treasury unleashes this massive fiscal stimulus, the government will have to issue more debt. Long yields will go up, and the Fed will have to step in to actually buy more of those, pushing them down and also pushing the dollar down. I think that's a hard sell as well for the Fed. So that's not my base case, but it's certainly one scenario for the Fed doing more.
Financial stability, 1. Price stability, 2. The labour market, 3. All things they talk about, all things they try and guide us through. Yet there is this other thing that Megan has alluded to just there, George, and I do wonder whether it matters. Funding costs for the Treasury, for the government. We've been talking about hand-in-hand an effort between the Treasury and monetary policy too. Do you think there's a factor there that we need to pay attention to?
I think we got to watch it pretty closely. I mean, Janet Yellen this week kind of mentioned that, basically interest costs to the U.S. government have come down pretty significantly over the past decade or so, but certainly over the last couple of years. And to the extent, sort of the curve steepens and the U.S. has to issue into that higher term structure, then yes, we do need to be concerned about kind of rising borrowing costs, especially given the size of our debt load. But to the extent the curve stays, relatively steep with low front end yields, yields, that's still a ways away. We're not quite at that point yet. And so sort of the refinancing of the debt remains at very low historical costs. So there's not a lot of pressure from the Treasury's perspective in terms of funding costs. They could still term out debt and still kind of reduce or drive down their average cost of borrowing. And so we don't think that that's a major concern here. As you point out, some of the auctions, certainly last month, the bid to cover ratios have been weakening. It's showing that there's some level of saturation, but the higher term structure should start to pull in new buyers, and we will find buyers. We are confident that both the Treasury and the corporate sector from that standpoint are going to find buyers, especially kind of where yields are now. I mean, just one point of reference, 10-year Treasury yields are now above the dividend yield on S&P. We haven't been there for quite some time. And so sort of the relative value, if you will, is actually starting to improve as bond yields move up. As relative value goes up, that will start to sort of draw new buyers into the market. So it's something we watch, and certainly it's a meaningful technical, but from what we've seen so far, we are not seeing material signs of stress or indigestion in the debt funding markets. There's been a couple technical glitches, but not much more than that.
It's a fascinating moment. It truly is, and one for the history books for years, decades to come when we look back at this. We're witnessing, Vishy, a huge economic experiment. And the work that you guys are doing at Morgan Stanley, I find to be particularly interesting. Where you think we are in the cycle already, you're talking about shorter, hotter cycles at Morgan Stanley, and you already think we've gone through the first phase.
Right. I mean, the construct of a shorter, hotter cycle sort of has this following thinking behind it. If the Fed is going to be a lot more patient, and in terms of tightening the policy rates, that means that by the time they actually start to react by raising rates, inflation could have picked up to a high level, and therefore they would have to catch up by hiking more frequently or faster than they would otherwise, and that could result in the cycle being shorter than the previous cycles. I mean, I would emphasize here that it is this cycle. It's not exactly a big surprise that this cycle would be shorter, considering that the last cycle was among the longest expansionary cycles that we have ever had. So I think the way we are thinking about this is that if there is a consequence of patience, that we might need to do, the Fed might need to do catch up, and that catch up could end up shortening the length of the cycle.
I want to give you the final word on that, Megan. What do you think of that concept, that approach, that framework?
Yeah, so I'm not that interested in cycles because it suggests that our economy is naturally converging towards a single equilibrium. And economics is the only profession that still believes in this stuff. Most other sciences believe in multiple equilibria, or they believe that an equilibrium can change as conditions develop. And so, I think that this is a chance for economics to actually borrow from the hard sciences and update our thinking on this. I think it's a chance we're missing, unfortunately, but I just don't really buy business cycles and a single equilibrium.
George, I know you want to get into.
Yeah, I mean, I just make the point, that what's unique about this cycle, or what's new, is sort of the revving up, if you will, of fiscal stimulus. And so, the type of stimulus we're experiencing right now is very high octane. It's mailing checks to individuals that are ultimately going to be used in a relatively quick fashion. And so you do run the risk of sort of the boom bust scenario. And so that may require the Fed to have a relatively quick response function. The question is sort of what happens next. And really, if the main drivers here is going to be fiscal stimulus, and we're going to be leaning on more structural spending, well, then that actually kind of changes the dynamics, and we move away from sort of that very short term kind of high and low to something that kind of gets drawn out over like a longer term sort of smoother cycle. So while the immediate risk might be for a very quick response like we've seen over the past 12 months, the next 12 months may be equally as quick. Beyond that, it does sort of fall to sort of a more typical or a more normal cycle. So we don't want to read too much into this sort of multiple waves of very short cycles. It's all unique to sort of what's going on today.
George Bory, Megan Greene, Vishy, Tirupattur, sticking with us. Still ahead, the final spread, the week ahead, including another big week of economic data featuring the US payrolls report on Good Friday, on a holiday. That conversation up next. This is Bloomberg. I'm Jonathan Ferro. This is Bloomberg Real Yield. It's time now for the final spread. The week ahead. Coming up next week, a much lighter week for the FOMC, with Fed speak scheduled for just Presidents Williams and Harker. Take a deep breath. On the data front, we'll be getting US auto sales, ISM manufacturing figures, and another round of jobless claims. And then finally, on Friday, the US equity market closing for the Easter holiday, but we'll still get the US payrolls report at 8:30 Eastern. It's happened before. I have no idea why we're still doing it. George Bory joins us now, Vishy Tirupattur and Megan Greene. Vishy, just quickly if you can, when the payrolls report comes out Friday at 8:30 on a public holiday with the bond market shut, what do? Just ignore it until Saturday, Sunday? Do you even get up in the morning to look at it?
You always pay attention to payroll reports. This is an important report. We'll watch not only the headline number, we also watch for the broader measures of unemployment rate. We look at the participation rate, and also in terms of the unemployment rate in the African American community and the Hispanic community. All of these measures are important. We know the Fed is paying attention. We will pay attention as well.
A very sensible, Vishy, just in case Mr. Gorman is paying attention to this programme right now. Vishy Tirupattur will be working on Friday when the payrolls report comes out at 8:30 Eastern. Guys, let's get a final word, the final round, the rapid-fire round. 3 quick questions, 3 quick answers. I'll try and get all 3 questions in. Above target inflation, transitory or persistent? Transitory or persistent? Megan?
Transitory. I think a lot of people underestimate how much of it will leak out given how much we're importing in our globalized world.
George, transitory or persistent?
Transitory, but longer than expected. I
Vishy?
think this runs for several months.
Transitory, but as George said, longer than expected.
Got to be shorter answers, guys. The 10-year, the US 10-year, finished the year closer to 3% or 1%, closer to 3% or 1%. Vishy?
1.7%.
Megan?
Closer to 3%.
George?
Closer to 3.
Final word, we'll squeeze this in. Been trying to gauge this. Fed hike in 22, 23 or 0 for longer. Which one, Vishy?
23.
Megan?
22.
George?
End of 22.
There we go. Guys, great to catch up. Fantastic panel. Megan Greene, Vishy Tirupattur and George Bory from New York. That does it for us. Enjoy your weekend. Get some rest. I'll see you next week. This was Bloomberg Real Yield. This is Bloomberg.